All right, prepare and analyze an income statement using absorption costing and variable costing. Again, I want to say it's review, but just to be safe, variable costing, and I'm going to abbreviate variable costing. We are going to start with revenue. We are going to subtract all variable costs to determine contribution margin. Then we will subtract all operating expenses and all manufacturing overhead. Again, all fixed manufacturing and all fixed operating expenses to determine net income. Important to note, all variable cost, that is all that is all manufacturing variable and all SG&A variable. Under absorption costing, AC, we have revenue minus all manufacturing costs. So that would be direct material, direct labor, variable overhead, and fixed manufacturing overhead. That determines gross profit. And then from gross profit, we would subtract all operating expenses, whether they are fixed or variable, to determine net income. Okay, so moving on. Here is the information that we are going to use, and this is very similar to the last lecture in chapter 5. Here's the data. Okay, so we have direct materials. Those are going to be $4 a unit, and direct material is obviously variable. Direct labor, $8 a unit, obviously variable. Variable overhead, so this could be supplies and indirect material and direct labor. Obviously, the more units that we produce, the more supplies and indirect labor we're using. So we have variable overhead. Then we have fixed overhead. That's, the rent on the facility, the depreciation on the equipment, assuming it's straight line. But we have fixed overhead costs of $600,000 per year. Then on the selling and administrative side, we've got variable SG&A of $2 per unit, and then we have fixed SG&A of $200,000 every year, right? And then we're going to sell every unit for $40, okay? So this is the factual background in terms of the product costs and the sale price. And then this is the assumptions regarding production and sales. So the first scenario we're going to go through is we're going to look at a situation where we're going to produce 60,000 units and then we're going to sell 60,000 units. So they equal each other. And then we're going to go through a scenario where we produce 60,000, but we only end up selling 40,000, right? So we're not selling everything that we produce. And then finally, we're going to go through a scenario where we actually sell more than we produce, right? So again, if I anticipate that I'm going to sell 80,000 units and I've already got 20,000 units in inventory at the beginning of the period, then I've only got to produce another 60,000 in order to sell the total 80. So it's very likely the case that we could sell more than we produce. Okay? Those are the 4 scenarios. Sorry, those are the 3 scenarios. The first one we want to go through is income equals, units produced equals the units sold, okay? And so I think I'm just going to blow this up for a second, if I can, and go through the income statement using absorption costing first, okay? So we're going to sell 60,000 units, and we said we would sell every unit for $40 a piece, and therefore $2,400,000 in revenue. Then we have cost of goods sold, and remember we said cost of goods sold is going to be all the variable costs of making the product and all the fixed costs of making the product. And what we want to do is we want to therefore deal with it in 4 approaches, right? So the first one, we said the variable direct material is $4 a unit. And then we said the direct labor is $8 per unit. That was from the previous slide. And we also said the variable manufacturing overhead is $3 a unit. And then what we didn't do is we said, listen, fixed manufacturing overhead is 600,000 a year, and we are going to produce 60,000 units. Okay? And the important thing to remember is that we are selling all of those units. So 600,000 divided by 60 is $10 per unit. So if I add all of those up, I've got, what is that, $25 per unit, right? Which is this $25 per unit times the 60,000 that we sell. I get cost of goods sold of 1,500,000. I now have gross profit of 900,000. Then I'm going to subtract all of my SG&A. Remember, we said when we're using absorption costing, we are going to expense all period costs in the period that we incur them. And so in this example, we have 200,000 in fixed SG&A, and then our variable SG&A is $2 per unit. And we are going to multiply 60,000 units that we sold times the $2 per unit plus the 200,000 in overhead to get 320. And therefore, 900,000 in gross profit minus 320 in fixed and variable selling and administrative expenses gets me to 580,000 in income. All right, same set of facts. However, we are going to now go over absorption costing. Okay. So we're going to sell 60,000 units at $40 per unit. We got 2,400,000. Under variable costing, man, I'm killing myself. Under variable costing, we are going to include all variable costs. So that will be the variable cost of goods sold. And again, that's the direct material. In fact, let's make sure we get that. That's the direct material of 4, the $8 of direct labor, the $3 of variable overhead. Okay. For a total of, maybe I should, actually, I guess, wow, look at that. That's crazy. Anyway, let's see if I can fix that. Let's do this right here. Okay, actually, let's maybe slide it just a little. Okay, variable expenses. 60,000 units times the $15 per units of variable cost of goods sold. And then we were saying the variable selling and administrative expenses were $2 per unit. So 2 times 60,000 is 120. The two combined give us the 1,020,000 for total contribution margin of 1,380. Okay, then we subtract all fixed costs. When we are using variable costs, we take all the fixed expenses, so that would be all fixed overhead, 600,000, and all fixed selling and administrative expenses of 200,000. Right? So 800,000 in all fixed costs for income of 580. If I was taking notes, this is definitely what I would take notes on right now. What we are saying is that when the units produced equals the units sold, then our net income under absorption costing is going to equal net income under variable costing. Okay, in this example, we're going to use the same set of facts, the sale price, direct material cost, direct labor, etc., etc. However, now we are going to say, hey, listen, we're going to produce 60,000 units. I guess we're making skates, but we're only going to sell 40,000. Okay. So I'm going to zoom up a little bit here and then Hopefully I can. There we go. Okay, so let's do absorption costing first. Again, we are, this is funny. They have the wrong assumptions in here. They're saying we are selling 40,000 pairs, and yet it says 80,000 there. What is, yeah, this is all totally wrong. Man, am I getting this wrong? We're going to produce less units than sold. We're going to produce less units than sold. And we have production of 60 and sales of 40. I'm thinking maybe this needs to be 80. We're going to produce less than what we sell. Okay. Let's just, units produced exceeds. Huh. Oh, look at that. Okay. Yeah, there you go. Okay, so let's do units produced exceeded units sold. Okay, so this one is right. Wow. This one is wrong. Yeah, this is definitely needs to be 80,000, where units produced is less than. Okay, so going back to this example, this looks right. Okay, good. We are producing 60,000 units and we are going to sell 40,000. Okay, so now I'm going to enlarge this again. Bear with me just so I can zoom in here. Okay, so let's go through it. We have, I'm just going to try to move that over there. 40,000 units sold at $40 a piece, 1,600,000. Cost of goods sold, again, is $25 per unit. And we are getting that with the $4 direct material, $8 of direct labor, $3 of variable overhead, and $10 of fixed overhead. $10 of fixed overhead, again, that is the 600,000 in fixed overhead divided by the 60,000 units produced. However, we only sold 40,000, so in this instance, our cost of goods is $1 million. Gross profit 600,000, and then we're going to take all of our SG&A. All of the SG&A gets expensed in the period that we incur them. Remember that the cost of goods sold, we're only going to recognize the fixed cost of goods sold to the extent that we sold those units. However, when we are talking about selling and administrative expenses, it's a period cost, and so we recognize all of the fixed costs in the period that we incur them. And this is when we are talking about absorption costing. Okay, so 200,000 in fixed costs times, or plus, I should say, $2 in variable selling and administrative expenses times the 40,000 units for a total of 280. We get net income using absorption costing of 320,000. Now, let's move over to variable costing. And what I'm going to do is I'm just going to highlight the conclusion first. We're going to come up with something less using variable costing. And it is because when we are using variable costing, we are going to treat all of the fixed costs, including all of the manufacturing fixed costs, as a period expense. Okay, so while we were using absorption costing, we only recognize the portion of fixed manufacturing that we sold because it's a product cost. So if I didn't sell something, it's sitting in finished goods. However, under variable costing, we're just going to treat all of the fixed costs as period costs. So let's go through this. I'm selling 40,000 units, 40 a piece, 1,060,000. Sorry, 1,600,000. My variable cost of goods sold is 15. That's only going to be the direct material, direct labor, and then the portion of overhead that's variable. Okay. For 600,000. So it's a total of $15 for 600,000. And then I'm going to account for all the variable SG&A, $2 per unit times 40,000 units for a total of 80 for all variable expenses of 680,000, and therefore our contribution margin is 920. Then, like we said, we're going to treat all fixed expenses as period costs, regardless of whether it's manufacturing or SG&A. And therefore, I'm going to take all of the annual fixed manufacturing overhead of 600,000 and all of the fixed selling and administrative of 200 for a total of 800,000 in fixed costs for total income under variable costing of 120,000. So this is an instance where we produce more than what we sold. Okay, so when we produce more than what we sold, my absorption costing is going to exceed my variable costing. And that is because some portion of the fixed manufacturing expenses are included in product costs and are included in finished goods. Because remember, we produced 60,000 units and they moved their way through production, material to work in process to finished goods, right? We produced 60,000 units. However, 20,000 remain in finished goods, and then we sold 40,000. And so fixed manufacturing overhead is sitting in finished goods in this example. And therefore, since we didn't recognize all of the fixed overhead, our income is slightly higher. Okay, now we are going to cover units produced is less than units sold. So there was a typo in our stuff and I corrected it. Pat pat on my back. Okay, so absorption costing, man, we know the routine. Now we're selling 80,000 units. The sale price is $40 per unit. Total sales, 3,200,000. Now, I think this is where we want to pay attention. Cost of goods sold, 80,000 units times $25 per unit of overhead. And I think what we're saying is from the previous period, man, do I need to make this more complicated? I'm just going to do it anyway. I'm going to make it complicated. The previous period we incurred 600,000 units and we produced 60,000 units. And therefore, from the previous period, our per unit cost was $10. Okay? And then we only ended up selling 40. Again, this period, production is 600,000. And then we're going to produce another 60. Fixed overhead is 600,000. And therefore, again, the per unit fixed overhead price is $10. The reason why it's $10 last period and $10 this period is because each period we produced 60,000 units. I would really pay attention to that in the homework. If I produced more or less from period to period, you need to pay attention. And we'll look through the homework when we're done with all of these lectures to see if that will be an issue. But for now, it was $10 in the previous year per unit. And in this year, again, it's another $10 per unit. So I think we're good. Okay, so 25 total times the 80,000 is 2 million. Gross profit 120,000, sorry, 1,200,000. Then we're going to take all of our SG&A expenses, the 200,000 that's fixed, and then the 80,000 units that are variable times the the $2 per unit of variable SG&A for a total of 360. And therefore we're going to have income of 840,000. Then we can just as easily go over to variable costing. And again, our revenue is going to be the same. It's the 80,000 units times the $40 per unit. The variable cost of goods sold, okay, that's just going to be the direct labor, the direct material, and the variable overhead. We're not including the fixed overhead. So it's only going to be $15 per unit times 80 that we sold. And then we're going to include the variable SG&A. And we said that was $2 per unit times the 80,000 we sold for a total of 160,000 for SG&A. So SG&A plus manufacturing gives us 1,360,000 in total variable costs, which leads us to a contribution margin of 1,840,000. And then again, in our variable costing, we are going to treat all fixed expenses as period costs. And so we will have 600,000 in fixed manufacturing overhead from this year and 200,000 in fixed SG&A from this year for a total of 800,000. And our income is 1,040,000. Now, the important thing to remember, again, when units produced is less than sold, then our absorption costing is going to be less than variable costing. And the reason is because the fixed expenses that were in finished goods from the previous period are going to be recognized this period as expenses, right? Because remember, we were saying, I'll just write it up here. We were saying last period, our fixed costs for manufacturing were $10 per unit. We had 20,000 units in finished goods, which means we had $200,000 of fixed overhead that was not included in income. And now we're taking that 200,000 plus the $10 per unit times the 60,000 units that we produced in this period, which is 600,000. So we're taking all of the fixed expenses from this period and 200,000 from the previous period that weren't sold, and they're all getting included this period. So all of our fixed expenses are exceeding the fixed expenses using variable costing. Because under variable costing, we only include the fixed expenses that we incurred this year because last year we included them all last year. Kind of confusing. This is a good summary. And I think that's what we were saying. When production and sales are equal, absorption costing and variable costing are going to be equal. When production increase or exceeds our sales, absorption costing will exceed variable, and that is because of the fixed manufacturing overhead. And then when production is less than our sales, absorption costing will be less than variable costing, again, because of our fixed manufacturing overhead treatment within absorption costing relative to variable costing.